A business update now. President Joe Biden remains confident that they could strike a deal on the U.S. debt ceiling as the government comes dangerously close to running out of funds. Mr. Biden and Republican House Speaker Kevin McCarthy have agreed to negotiate directly to avoid a historic default after a months-long standoff.
To be clear, this negotiation is about the outlines of what the budget will look like, not about whether or not we're going to, in fact, pay our debts. The leaders have all agreed we will not default. Every leader has said that.
The president and Leader Schumer have finally backed off their idea that they won't negotiate. They finally backed off the insane, unrational, unsensible idea that you just raise the debt ceiling.
Well, a negotiating team of White House officials and House Republican leaders will work at hammering an agreement even with President Biden away in Japan for the G7 summit. Their goal is to seal a deal by Sunday, a U.S. time, when Mr. Biden returns to Washington. The Treasury has been warning that the U.S. will run out of money to pay its bills as early as June 1st unless the borrowing limit is raised. But extraordinary measures are already draining the coffers. So the government's money on hand is down to $87 billion as of May 15th. That is well below the targeted year-end balance of $600 billion. And corporate America is getting concerned. Leaders from top banks, including JP Morgan and Citigroup, met with Senate Majority Leader Chuck Schumer to discuss the debt limit. JP Morgan CEO Jamie Dimon says the bank is prepared for whatever scenario may unfold, but he says the U.S. would probably avoid a catastrophic default. Well, meantime, U.S. stocks, those closed higher overnight on optimism that the debt ceiling impasse may be resolved to avoid a historic default. All three major indices ending more than 1% up for the session, with the debt crisis overhang at least partially eased. Meantime, sentiment on the street also bolstered by regional banks. Western Alliance soared more than 10% after reporting improving deposit growth. Other regional lenders closed higher, with PacWest and Zions Bancorp also gaining ground. And Tony Nash, founder and CEO at Complete Intelligence, joins us now. Tony, well, the debt ceiling agreement may not come so soon, although we're seeing some positive signs from both sides of the aisle. Do you expect markets to continue to whipsaw then?
Yeah, absolutely. I mean, it's good that both sides are at the table now, right? I mean, that's progress over just a few days ago. But I've heard some people say they expect a deal over the weekend or something. I just don't see that happening. It seems to me the parties really want the drama. Both sides of the table want the drama because they're really driving their policy issues home to their base. And we don't expect the agreement to happen until probably mid or late June. So just overnight, we had an announcement from the Treasury that they found some money. So, that X date, we'll see that go further and further back over the coming weeks in order to give room to the parties to negotiate. And, we'll see something probably in mid-June, I think.
Well, in the meantime, we're also looking at the banking crisis. That's something that the markets have to grapple with. Western Alliance, they're injecting some confidence back into the sector with the reports saying that, deposits grew in Q2, although regional bank stocks still largely, they remain depressed. Is it too soon to say troubles are over? Is this something that the markets also need to bear in mind?
Yeah, I don't think we've had troubles for a few weeks because the U.S. Treasury put out a program so that these regional banks could borrow for up to 12 months to make sure that they have the liquidity to backstop their depositors. So I think the market is catching up to that Treasury program, and they're seeing that banks are actually borrowing from that facility, and they're fixing their duration risk. Remember, they had these bonds that they held with a very low interest rate, and that couldn't keep up with the needs of depositors who wanted higher interest rates. And so these deposits left. So with that borrowing window, it gives those banks a facility to fix that problem. And yeah, we're seeing some traction behind that and some confidence.
Attorney, at the same time, leaders of those failed banks in a Senate hearing have blamed the high interest rates for their demise. And as we've heard from central bank officials earlier this week, they're going to be holding on to those rates for a while longer and even possibly looking at hikes ahead. How would this bode for the sector?
Well, I think the banks that went under were actually, they had the worst risk management of all the banks, and it's obvious. So those management teams didn't manage their risk well, and we're seeing the banks. We have a lot of regional banks in, say, South Carolina and other places here in Texas that are managing just fine. Of course, they saw some volatility over the past few months, but there are hundreds of them that are doing just fine. So those guys who were on Capitol Hill talking were really kind of the worst managed. Unfortunately, there's some of the bigger names too, and so they paint a really negative picture for a lot of well-run regional banks.
Then maybe it's safe to say that it's not representative of the entire sector. And then in that sense, in that case, are the markets poised to handle further rate hikes then, if that is on the cards? Is the U.S. economy also, you think, able to defy expectations of a recession this year?
Well, our view is that the U.S. is going to slow significantly in Q2 and Q3. So we still have an inflation problem. So the Fed is still justified to hike at the next meeting unless we see a change in those inflation readings. If we see changes in those inflation readings, they may very well just take a pause. But if things continue to move as they have in the most recent readings, then they may very well continue to raise. And again, with this treasury facility for the banks, the banks are backstopped. We see the dollar strengthening and we see equity markets rallying. So I think people are starting to be comfortable with this higher for longer environment where we see these interest rates higher for maybe the next 5 to 6 months, after which we pause, we continue to pause and maybe cut going into 2024.
Many thanks for joining us this morning. Tony Nash, their founder and CEO at Complete Intelligence. And I'll be back with more in the next hour. Meantime, you can get your business updates across all of our CNA platforms right here on Asia First TV, on radio CNA 938, and on digital cna.asia/business. Julie and Steve, back to you.
All right, Liz, thank you so much. Coming up on Asia First, as a Black Sea Grain deal was set to expire today,